Well, hello. It's been an exciting couple of weeks for all of us across many different asset classes, uranium not being any exception. We've had some downside movement and our immediate upside seemingly has broken, but that does not mean that we're completely out of hope for any kind of rally. We're going to look over the 4Us, Energy Fuels Incorporated, UUUU, and URNM, and the URA ETFs. And we may be looking at the Dow and the stock market in general as well, because these are all equities after all, and they all seem to line up with one another. So this is UUUU, as I mentioned. And well, we had a breakout setup developing as of mid-April, but that has fallen apart. We were looking to break through this pivot zone up here, as you can see with this text written as here, and we didn't quite make it in the pivot. We had better luck in the URNM ETF, in which we actually broke through the top of the pivot, which is generally a very good sign that a true third wave is underway. But then we back right back down. And I think I highlighted in our last update that we had what looked like 3 waves down. I was expecting a 4th wave bounce and a 5th wave lower. And it looks like we have had exactly that. When we look at URA, very similar story. We went deep into the pivot region, but we did not break through the top of it. So that gives us, well, that gave us immediate reason to pause. I mentioned I had an options call for URA that I jettisoned relatively quickly after we broke our supports. So I have not had any longs or leverage within the uranium complex. And here too, we've had a bit of a 4th wave bounce seemingly, and we have a 5th wave lower. And in addition to that, we're seeing a MACD divergence. So we see that we got very stretched down on the 3rd wave with a little less of a stretch in the 5th wave, which is a classic bottoming sign. Now, it's not a guaranteed thing. It's not a rule, but it's something we often see. We see the same thing in URNM and in UUUU, same exact thing. So where does that leave us? Well, this is probably best identified as a bigger second wave. So we were looking at a nested setup in which we had a 1-2 and then a 1-2 forming. That was the green original pattern, but this looks way more corrective. This looks like an A, B, and a C, possibly even a double zigzag, with what looks like an impulsive C wave coming back down. So this whole thing is best interpreted as an A, B, and a C wave for basically an expanded flat wave 2. That's what I have in red, and it should be interpreted the same way in each of these. There's not too much difference. Could be an A, B, and a C here as well. That's what this blue line was specifying in our last update. And same thing with URA, although it has more of an ending diagonal look to it, it could still be interpreted the same way as well. Again, A, B, and a C. So how do we know what's going to happen next? Well, if we are to preserve this setup, this red number 2, as it stands, we need to see a sharp reversal. So today was a good start. We had, 2.5% returns, single day returns today as of May 3rd, 2022. And we've seen a similar bounce across many asset classes. We saw the same thing in cryptos as well as our equity space. We had about a 0.5%. We were up, I think, almost a 1% at some point in the S&P 500, although we're looking much weaker in other parts of the equities sector. And the Russell small caps actually did have a much more impressive day. Looking at the bigger picture long term, if you recall some of my updates from further back, not necessarily the last one, but further back, we were looking at the big picture for the 4Us, in which we had what seemingly was a major top, a first wave, and we were looking for a relatively deep second wave. And even if we didn't get the deepest second wave, we didn't quite get deep enough even for a shallow second wave. So we were looking for an A B wave fake out rally, and a C wave down. That alternate pattern still looms, especially because of the way we failed to launch in our latest rally setup. So while we could still look at this as a 1-2 maybe, it's getting a little bit, well, I wouldn't say sketchy, but it's getting a little suspicious, at least in the 4Us. When we look at the MACD, we're stretched to the bottom. We haven't quite gotten as stretched down as we had earlier in this year, but again, that red pattern looms, and we are seeing similar setups in the NASDAQ and the Russell, in which it seems like we have a good ways to go before we're done. If you recall, this purple box, purple lavender, whatever you want to call it, this is the 38.2% to 61.8% retrace of this larger first wave. That is a standard bottoming region for a second wave. And honestly, it looks like it very well could be. It's very convincing, especially with the failure to launch in recent weeks, that we could see that. I'm going to shift over to URNM. So this is, again, it's the Sprott Uranium Miners ETF. I feel like it wasn't called that before. Wasn't that the Northshore? Maybe it was. So 1, 2, 3, 4, 5, same exact pattern. And here too, we didn't quite go as low as we would have expected for a second wave standard pullback. Our 38% retrace mark would fall at about $50. So I'm going to draw a box on here. Not sure why I didn't have one here in the first place. So anywhere from there all the way to as low as about $32, that would be the bottom of the box. Now, technically, you could go all the way back to the origin point of the initial rally, although we wouldn't want to see that. Typically, 76.4% retraces are about as deep as you would expect for a second wave. So again, this could actually be a 5 up, 1, 2, 3, 4, 5, as I mentioned, although I think it better counts as a, well, we took a closer look at it. It looks like a fake out. So the whole thing could be a 1, 2. And finally, URA, which is the global X Uranium ETF, exact same situation. We have our second wave here. And before I forget, I think I put the one nomenclature in the wrong spot. It should be an expanded flat second wave. So I just want to fix that before forgetting and confusing myself. So when we look at this, same situation. And here too, we had probably an even shallower retrace than we had in the other ETF. So I'm going to actually draw a box here as well, just to give a clear visual on what we're looking at. So this is about, it starts about 1771. That would be the top of the retrace box for the second wave, and the bottom would fall around 1246. So I'm going to draw that box to size as you see here. And I'm going to leave this at the 50% just to split the difference. So that is what we're looking at long term. I'm going to go to this, the Canadian version of this ETF, in which it's almost the exact same pattern, identical. So that's what you'd expect. Same kind of thing, same companies, presumably. I can't remember exactly what equities it represent under the hood. So while this is the uranium complex specifically, I'm going to shift over to the Dow real quick, in which we're having the same situation. I'm going to get rid of my drawings just to declutter this a bit. But we had a top back in January, so earlier this year. And you could argue that the top is actually back here in November or up here. I know the crypto heads will argue it was in November, but regardless, we've been in a prolonged correction, very characteristic of a fourth wave in which it's very long. You have a lot of corrective patterns, clearly a 3-wave rally here, 3-wave pullback here, very sketchy 3-wave looking rally there, another 3-wave here. So lots of zigzag patterns. This rally was representative of our, well, it was indicative of the idea that we had a bit of a failure to launch. So we had 1, 2, 3, could have been a nice fourth wave and a fifth wave to come. We didn't go high enough for the fifth wave, and then we took a cliff dive. That peak was on April 21st. So remember that date. We may compare that to the uranium complex, and we are presumably in some kind of a C wave impulse. I know there's no clear 1, 2 structure here. It would probably be more visible if we looked at the futures view. So I'm going to take a look at that real quick. I guess it's not as visible in the Dow index as it has been in the ES futures for the S&P 500. But regardless, we have presumably had a fourth wave bounce, and we're finishing off what is probably a fifth wave down for our C wave. So when we look at this again, big picture, if we consider the bottom on February 24th, we have an A, B, C up. That whole thing is very likely a B wave fake out with our C wave completing. So again, the uranium complex these are stocks at the end of the day. So the sentiment is, how do I put it, is concurrent, is confluent with what we see in equities. It may align better with small caps too. A lot of these stocks are in different indices. So in summary, we have the looming specter of that lower low. If you would like to short, it actually would not be a bad short play. I may consider it. I have not really put much thought into it because I was looking at the bullish long play. So if you're a long-term holder, depending on where you got in, if you got in way back in 2020 or earlier 2021, it may be best just to hold through this correction, because again, we have a very bullish setup. This was a multi-decade low in the uranium complex. So I would see this as a buying opportunity, especially when it starts getting really scary. People are going to be yelling from the rooftops that the world is ending. There's already all sorts of people out there calling for a recession looming. I do think they're right. It's just a matter of when. I don't think we're going to be in a recession just yet. If we look at the big picture Dow chart, we at least have one more quality rally based on the Elliott wave structures in place. So there you have it. Right now, I don't see any high confidence play. Definitely not a long leverage play. If you are holding for the long term, probably better just keep holding unless you want to reduce your risk or exposure. You could hedge using a put, because again, there may be a good short play developing here. I would like to see more of a second wave bounce. So again, if this is actually a first wave down, I would like to see a second wave bounce. So you would expect to see some kind of a 3-wave corrective zigzag up. And if that happened, that would give us a very solid basis. That would be a 1, 2, and that would be a great place to short from, because if we got up to about, I'm going to assume we have a 50% retrace, about 941 in at least UUUU. When we look at this thing in the 4Us, that would put us in, well, I can actually do a Fibonacci retrace off this. Why didn't I think of that? So got our first wave down, presumably a 50% retrace to split the difference, $9. That would target down to 268 or lower in the linear chart. Now, before we confirm it, looks like the big picture chart. Yeah, that range does fall. That would be towards the bottom of the box. More likely, we'd probably bottom somewhere in the top of the box. About 388 would be the ideal bottom, I think, the 1.32 extension. So again, it could be a lucrative short play. May have more details on that. So like I said, the long-term bull is far from dead. This is just a much needed completion to what was a very shallow second wave. I've been reiterating that throughout my many updates. So subscribe so that you don't miss any more developments, because it could be quite a commodities bull market, not just for the rest of the year, but for many years to come. Very exciting opportunity. If you enjoyed my video, don't forget to give me a like. Till next time, thank you for watching and happy trading.